Good morning, everybody, and welcome to our June edition of IFRS and Corporate Reporting. And in this webinar, we'll be looking at how to implement the TCFD disclosures in your 30 June 2023 financial statements. I absolutely cannot believe that we're nearing 30 June. It feels like just yesterday that our family were on our big holiday in America for a whole 4 weeks. And here we are, 30 June. I mean, how is this possible? Anyhow, we're getting ready. We're on the countdown to 30 June, and I hope you're all getting ready. The presenters, as always, I've got with me Kevin Frohbus, who's our IFRS and corporate reporting partner in Sydney. So, Kevin, thank you for joining us. Lovely to see you.
Hello, Aletta, and hello to everybody, and it's lovely to be here. And I know it's getting to June because it's 5 degrees outside in Sydney this morning, so it must be middle of the year. Lovely to see you all, and lovely to see you, Aletta.
Thank you. I agree. It's only the weather that gives an indication it's the middle of the year, Kevin. We would like to begin by acknowledging the traditional owners of the land on which we meet today. And we would also like to pay our respects to elders past, present, and emerging. And we also extend that respect to Aboriginal and Torres Strait Islander peoples here today. So if we look at our agenda today, we will start off by discussing the latest international developments, then the latest Australian developments, and then we get to the TCFDs. Why are TCFD recommendations important to consider, especially now for 30 June 2023? What are these recommendations? And then also a bit of an update on the current use of the recommendations and some examples of entities that are really doing a great job around implementing the TCFD recommendations. And we'll wrap up with some next steps. So, Kevin, today you are starting, so it's over to you. But, I forgot about the webinars. I just wanted to flag that initially we released 6 webinars up to June around sustainability. And just a week or so ago, we've launched the next 6 webinars for the rest of the year. And these 6 webinars are very strongly aligned with the TCFD recommendations, which we are discussing today, because the TCFD recommendations require the disclosure of your Scope 1, Scope 2, and Scope 3 carbon emissions, and also your decarbonisation strategy. So we've very specifically designed 6 webinars where we look at setting your organisational and operational boundary, measuring Scope 1, measuring Scope 2, measuring Scope 3 over 2 months, and finally, we'll be looking at decarbonisation strategies in December. So these 6 webinars absolutely, closely linked to what we talk about today around TCFD recommendations. As always, our IFRS and corporate reporting webinars have already been scheduled for the year. And next month, we'll go back to my favorite topic, leases, and the challenges of applying lease accounting. Kevin and I continue to be astounded about the number of requests we still receive around lease accounting. People still looking for lease accounting solutions, technology solutions, or assistance. And BDO is actually partnering with a large software company where they'll be reselling BDO Lead and integrating it into their software. So for us, that's a new frontier. But we can tell you all about that in July. Then, before I hand to Kevin, on Friday this week, we have a face-to-face event, a lunch in Melbourne. The first time in many years that we're doing an IFRS face-to-face event in Melbourne. And we'll be talking about the evolving state of sustainability in Australia and why you need to prepare now. We already have 80 people registered, so we're very excited about that. So if you still want to come, it's not too late. There's a link there to register or email me, and we would love to see you. It's just going to be nice to see people again. For so long, it's just been webinars, especially through COVID. Now, Kevin, I can hand over to you. So I'm handing over on the latest international developments.
So thank you, Aletta. So part of the session will actually just be to give a sort of a high-level overview of where we've come from, and just kind of show you where we're heading. Bearing in mind that what's actually happening with TCFD and its integration into, shall I call it, financial reporting, and its link to financial reporting is still an ongoing development. It's still an ongoing change. Remembering that the TCFD, which is Task Force on Climate-related financial disclosures, if you kind of break that up into its components, as it says, it's climate-related and financial disclosures. So it's really the link of how climate risk, and climate opportunity feed into governance and business strategy, feed into the numbers, which finally feed into your financial reports. That's essentially the high-level component of this. Just the sort of background again, we would have shared this in a number of webinars before. Just reminding everybody that coming out of COP26 was the creation of the International Sustainability Standards Board. This is a sister board to the International Accounting Standards Board, and they are producing the IFRS Sustainability Disclosure Standards and linking that to financial statements. It's all linked to financial reporting at the end of the day. That's where it's going. And they consolidated out of there a number of standards and frameworks, SASB, TCFDs, the GRI, all feeding into the ISSB, and those standards are, shall we call it, informing and incorporating what is becoming the ISSB standards. Long and the short of it is the ISSB standards are, shall we call it, the standards that the International Accounting Standards Board and the International Accounting Standards Foundation are creating for worldwide adoption of, shall we call it, investor-focused capital decisions in financial reporting. And so that's where we're heading. Where do they end up? Well, we've had for some time now 2 exposure drafts that have been lurking around. The first one being general requirements for disclosure of sustainability-related financial information, and then IFRS S2 is climate-related disclosures, which is, shall we call it, the bigger of the beneficiaries of the TCFDs, although the TCFDs also informed the base standard being IFRS S1. The big announcement out of this is these are the first 2 standards, and the 26th of June is the big date that these standards will be finalized and issued. And so the countdown is on. The ISSB standards will go from exposure and discussion phase to actual standard on the 26th of June. There's a big launch week, so expect to see a little bit coming out of that. I'll be in Bali actually on a little bit of a leave, so I'll actually celebrate the standards being released while I'm on a little bit of a vacation next week. But the standards will be out. But the important thing here is that it's not the end. And it's very important to kind of note that, yes, there's a big launch week, and I think they're getting together along with various other foundation and board setters to actually release these standards. But already in the background, we're talking about exposure drafts on S3 and S4, the next set of standards. The topics that we're talking about here are human capital and biodiversities and other topics coming down the road. So this isn't the end. In fact, it's probably just the beginning. So the countdown is actually happening. The hard launch, 26th of June. The standards will be out along with any amendments and disclosures that have come out, along with additional transitional reliefs that has been decided. And that's where we are. What's probably interesting as well, before I get into what's actually covered by these standards, is actually just to point out that there are some hints about how this is going to be applied around the world already coming out of certain regions. Now, one of the international developments is that recently the European Sustainability Reporting Standards, there was some information released on how they're going to adopt the reporting standards in their jurisdictions, bearing in mind that this isn't necessarily the TCFD or the S1 and S2, but this is the European Sustainability Reporting Standards, but it gives a hint of how regulators are adopting and transitioning to these standards. And you will see that they varied some of the mandatory dates and mandatory effective dates on some of the disclosures and who it applies to in the first instance. One of the changes that I've noticed with the Europeans and their reporting standards is they've linked the voluntarily and flexibility disclosure requirements They've changed some of the mandatory requirements to voluntary based on employee numbers in one of the categories. Now, I won't get into the detail on that, but ultimately what it's telling you is that different jurisdictions around the world will take these standards, including S1 and S2, and adopt them in their standards, probably in their own way. And that's not going to be any different in Australia. And Aletta, we'll probably address that later on in the presentation about which entities will have to comply with these standards first in Australia. And I think we all know that's going to be ASX first, financial institutions first, and probably some employee revenue or asset number that will drive which entities have to mandatorily adopt these. But also within the standards, there's certain disclosures that will probably have transitional rules about when you have to adopt them. And Aletta will deal with this later on in the presentation. But we all know that scope 3 emissions is one of those, the harder ones to actually get right. And so it's probably going to have some flexibility around when it's mandatory, and the Europeans have already adopted something similar. So that is the international development that's relevant here. The standards are coming. 26 June, S1 and S2 will be mandatorily issued, and then at that point, it will move to local jurisdictions deciding how to be implemented in their local regions. On the general requirements for disclosure, so this is just a high level sort of summary of what's in S1, and I'll do S2 after this. So S1 is the general requirements for disclosure of sustainability rate financial information. Should we call it its base standard? What it's trying to do is essentially set out requirements for comparable information, frequency of reporting, where things will be located in the financial statements. Will it be in the financials? Will it be in the directors and OFRs? Will it be a standalone document? All those sorts of requirements, and Aletta will also deal with that a little bit later in this presentation. And essentially how the subsequent standards will all fit together and how all come together, also linking to, shall we call it, the financial reporting standards. But the foremost important components in this standard is that it's informed by a number of different standards, GRI, TCFD, and so forth, but they've actually built the disclosures on governance, strategy, risk, and metrics and targets from the TCFD. It was the leader standard that drove, shall we call it, the reporting on governance, strategy, risk management, and metrics and targets. But that doesn't mean other standards were not considered. So GRI in particular, a lot of the disclosure requirements from GRI have been added on top of that, and so it has actually informed the creation of the standards. Structure of proposed IFRS S2 being the climate-related disclosure, and this is probably the base standard we're going to deal with today. Why? Because it's the one that's going to be probably mandatorily effective in the first instance in Australia. It'll go before the general requirements because climate is the one that everybody's focused on in the first instance, coming out of COP26 and also the net zero commitments around the world. This is the focused area. It's based on the TCFD, as Aletta's put in the top of the slide here. Governance, and by the way, this is a good roadmap as well in terms of how you want to start to think about these standards. The idea of the TCFD standards isn't just about making disclosures. It's actually designed to inform an entity to create its roadmap to actually integrate climate-related risk and opportunities throughout the business. And I've used the word integrate there because it's important. Just making disclosures isn't necessarily going to achieve the objective. Making disclosures and gathering data about metrics and targets and putting scenario analysis together to try and understand the impact on the financial information is meant to drive change in the organization to address those risks and opportunities. It's not just meant to be a disclosure and climate exercise. And that is why it's about governance, building that into strategy, identifying the risks into the risk management, identifying opportunities, and then setting metrics and targets to measure how the entity is adopting to risks and opportunities, how integrating it through the organization, how it's actually changing. In other words, how the metrics are changing year on year to actually achieve those outcomes. And then actually making disclosures on those. And obviously the disclosures is what then hits the financial reports or the financial disclosures that go with your annual and financial reports. The other thing that in the structure of the proposed IFRS S2 is how the SASB industry-specific metrics have fed into the IFRS 2. Now, why that's important here from my point of view, coming from financial statement background, we all seem to think that financial sometimes is just a compliance exercise. And in my world, financial reporting under IFRS has never been a compliance exercise. I have always maintained that your financial statements under IFRS is a window to your organization. It's meant to be a tool of communication that actually tells your story in financial terms to your audience, to your investors, about how you're doing, what your objectives are, what your strategy is, how your operations are going. And it's no different with the IFRS S2 climate-related disclosures. These disclosures are meant to be a window into the organization. It's meant to be a window into the organization about how you've approached your journey on this climate journey in terms of governance, integrating strategy, integrating risk management, and the metrics and targets to measure progress. The SASB industry-specific metrics are metrics that are pulled into TCFD. They are industry-specific metrics that apply to different entities based on what industry they're in, what they're doing, what their outputs and products are. So it's designed to identify the sort of the most specific industry targets, like water usage and so forth, depending on what you do, as a tool to help measure your progress towards achieving these outcomes. What's important here is that you don't have to start with TCFD. Some organizations have actually started on other frameworks. They've started with GRI, or they might have started with SASB. And so the idea here is that even if TCFD is the base standard that they've used in terms of S2 for governance, strategy, risk, you can certainly start your journey somewhere else, because a lot of those other standard setters standards have actually fed in to IFRS S2. And so IFRS S2 is the coming together of, shall we call it, years of transitions from different standard setters. And so this is a great way and a great place to actually bring it all together. On the next slide here, Aletta's got comparisons between IFRS S2 and the TCFD recommendations. This is actually a good guide if you're actually not starting with TCFD on your journey towards S2, because you'll see the moment when you go into this document, if you actually compare what the TCFD recommendations are versus what's in IFRS S2, some of the things that are IFRS S2 are actually the things that have come from SASB and GRI. So what it's telling you is, it's not that they're different, it's that it's a coming together. So you can start your journey somewhere else, but it's the base standard has informed S2, but other standards have also informed S2, meaning you can start anywhere, but this is the good coming together place. I think I'll leave it at that. Aletta, do you have any comments on that before we go on?
Yeah, I think for me, the key reason I wanted to put this in the presentation is a lot of people are saying, why would we spend the time and the energy to implement the TCFD recommendations 30 June 2023 and 30 June 2024 if we have to mandatorily implement IFRS S2 in 2025? It seems like it's a divergence. And actually what I wanted to say, it's not. Whatever you've done in the past, whichever framework, and what you'll be doing in 23 and 24 around TCFD recommendations are amazing stepping stones to get to that mandatory reporting place. And because they build on each other. So I think what I've seen working with clients and also doing this for our own business, Kevin, in BDO Australia, is these things don't happen overnight. It really is a journey. And it's important to start the journey. And I really think the TCFD recommendations, if you haven't started somewhere else, it's a really good stepping stone to where we have to go.
That's right, Aletta, and I think it's probably the main message of today's webinar has probably been delivered in some way or form, because I think that's the main message of today's webinar. Is TCFD has clearly informed S2. S2 is clearly going to be, and S1 are clearly going to be the base standards that are going to become mandatory in Australia, at least in terms of financial reporting and linking it to IFRS. But you don't have to start with it, but it is actually absolutely the stepping stone. And depending on where you've started, the way you use TCFD can vary. So for example, a number of organizations that I'm working with, and Aletta as well, are actually using TCFD to perform their gap analysis in the first year. So where are we starting from and where are we going to? What's missing? And they might not necessarily be trying to fix all the gaps in the first year, but they've
Yeah.
decided to make a decision to publish in a matrix form their gap analysis, saying, here's what the requirements are, here's what I have done, here's what I've not done, and here's my plan to get there. That could be a very great thing to do in 2023. This webinar is all about what should we be doing in 2023. That might be one alternative. It's the stepping stone, but it also doesn't have to be full compliance in 2023. It's coming. We know it's informing the mandatory standards. So take the stepping stone and work a route to get there. Gap analysis first, strategic overview first, and maybe it's just as simple as doing essentially a high-level inventory in the first year, saying, what have I done? What haven't I done? And what am I going to do going forward? And maybe that's what you're publishing in 2023, along with your financial statements. So that's a good point, Aletta. Right. So we'll talk latest Australian developments, and actually I'll do this one together with Aletta. Aletta, on the next slide, there's a couple of points we've put down there. Now, some of these, I think I've seen this slide on a number of presentations in the last 6 or 7 months that Aletta has done and I've done. So these are sort of the key topics of things that continue to develop. I think we've spoken about the alignment of TCFD and then ISSB down below. We know what's happening there. There's a standard coming. S2 and S1 have been released on the 26th of June, so that's the latest development there. But Aletta, in your view, what are the latest developments here that have changed lately that you can talk to? I don't actually think there's been much change in the process of phased implementation. The large listed entities, financial institutions was the initial group of entities that was put forward as this being applied to, but I don't believe that consultation process is over yet, and clearly we don't have a final ruling on that. Have you heard anything along the grapevine?
Yeah, so Kevin, as you know, this consultation paper published in December, I think a lot of the messaging in the consultation paper was so similar to the messaging we've heard globally at other jurisdictions and especially the ISSB. So surely there were discussions happening for sure. I think the next thing is Monday, the launch of IFRS S1 and S2, and that IFRS S1 and S2 has a implementation date or suggested mandatory implementation date for years beginning on or after 1 January 2024. So potentially 31 December 24 or 30 June 2025. Now that is, I would say, suggested for all countries, but then it's down to every jurisdiction to decide when are they going to mandate it. Now, if I think at how closely reliant this consultation paper is to the ISSB recommendations, exposure drafts and thinking, I personally expect a very similar mandatory implementation date in Australia. And they've given us enough warning and everybody's jumping up and down. The bit that we're waiting for is how it will be phased in across entities. Will it just be large listed? Will it be, will it be ASX 200 or will it be all listed? Will it maybe capture large emitters in the public sector, not for profit? That we're not sure. My expectation is that Australian Treasury is waiting for the ISSBs to be issued next week. And then within the next month or two, they will say, now that the standards are out there, this is what we would like or what we will mandate for reporting. I think they're just waiting. I know they've received a lot of comment on this consultation paper. They've been speaking to a lot of people, so I think they're just waiting for their time. We will know soon. I think that's the short answer.
And I think that's right, because bearing in mind what we're talking about here is the financial related disclosures and their mandatory application, but that doesn't mean that other components on the screen you can't start now. And interestingly, in my own journey, Aletta, in the last 3 or 4 weeks in particular, I've started to focus a lot on data and data collection, because obviously that is the step you need to do, and that fits nicely with the timeline that's on the next slide, Aletta, and which you've been talking to for some time to our audience, is about starting the journey now. We know that TCFD is going to inform the creation of S1 and S2, although there are other components in S1 and S2 like GRR and SASB. But at the end of the day, it's actually the processes and systems to capture data and to start to report on the data that's probably really important, which is why Aletta has actually built that into this timeline, which we've used somewhat before. You can see today we're starting our journey to prepare financial reports is a good place, but that doesn't mean you necessarily have to produce it this year. But it does mean that you need to start putting processes and systems in place to capture data, especially 1 July 2024, because that's going to be your reporting period in the first instance. There may be comparability years that come into that. There might be exemptions with some of the data in terms of comparability, but there'll certainly be, for those that are mandatory reporting, there'll be an obligation to put certain data in, which will be reported on for the period 1 July 24 to 30 June 25. That'll be the worst case scenario in terms of mandated reporting for certain entities. And so that's where you probably want to start. But I want to say with data and data collection, it's also important you get that right, because selecting a target like zero emissions by 2023 or by 2030 is something that actually has to be measured and reported on. And if you can't get your data right and you can't report on it, you may not be able to measure your progress towards it, and you may find yourself falling into the greenwashing situation really quickly, where you start to make claims about achieving it or moving towards it, but actually your data doesn't actually support it behind it, and it ends up you fall flat anyhow down the track. So essentially, start to think more about just governance and strategy. Start to think about how your processes and systems actually start to capture this data and how you integrate that in the system. That's probably the sort of thinking that I would say you need to worry about right now in terms of the way your board and your executive and management are thinking, and about how you actually start to think about how to integrate this throughout the firm.
And Kevin, I think that's a great point. And I just want to add, when we talk, the absolute topic that people are talking about is climate change. And it boils down to measuring your baseline scope 1, scope 2, scope 3 emissions. And that's why we released that series of webinars. But having an attempt and starting to measure those emissions is critically important, because when you start, you realize it is not easy. It's not necessarily the information required, the data required is not already captured in financial systems. It might be captured in weird and wonderful places if it's captured. So that is a real journey.
Absolutely.
And it's been an interesting journey. But definitely understanding what data you need to do that carbon footprint in order to set targets, to get to net zero, incredibly important.
One of our clients has actually mandated that their board members and senior management have to go on a location-specific visit around the country, because they've started to realize that the data involved in some of this is even different from one location to another in the organization. And so they're actually doing a geographical tour to essentially understand the systems and processes and the availability of information on a location by location basis, because a lot of systems and that we use for financial reporting are integrated, and they can produce information up to, let's say a central location to prepare financials. But that's not necessarily the true for the data used in carbon reporting. Those systems just haven't been built yet, and you actually have to start with what data can the source provide even before the processes and the systems to accumulate can be built. So it is actually quite a long journey. I might actually go through this section very quickly, Aletta, because I'd like you to get to the bulk of the presentation sort of quickly. So why are the TCFD recommendations important to consider? I'll run through these slides relatively quickly. We've used them before in previous presentations, but essentially what we're kind of showing you here is that all the regulators are saying the same thing. And I'm talking about the Australian regulators in this particular case, because we're talking about the Australian contract. ASIC's focus for 30 June 23 reporting periods, and yeah, we're talking about financial reporting periods. There's been a lot of focus on how directors and management actually assess the performance of the entity in terms of business strategy, risks, and opportunities, and how that's reported. This is not new. In fact, this is not linked to TCFD at all. This is just linked to requirements that have always been there in terms of reporting things like in your OFR, your business strategy, risks and opportunities. And one of the things that has been made clear there is that climate risk is one of those. So whether or not you're actually even starting your journey on TCFD and S1 and S2, if you're a company reporting into the under AS6 and you've got requirements to do OFR reporting, then this is already required and really should be thought through. And we've got 6+4+5 listed entities that have been challenged by ASIC in terms of their OFR disclosures. This is driven by Regulatory Guide 247, which essentially requires directors to make disclosures in their financial statements and directors' reports about their operating financial review, talking about operations of the entity, the business strategies and the prospects for the futures, and very importantly, and here comes the kicker, the risks that could impact those strategies and prospects going forward. And risks include the risks from climate, which need to be addressed. So this is already required and already should be thought through. A client I worked with recently actually listed all their risks for their OFR disclosure, and there wasn't a single climate risk in there because the board hadn't yet got there. The risk register hasn't yet considered it, and that's fine. Coming to the realization that your risk registers don't address climate is probably the first step before reporting on it, because then you can actually take actions as a board to deal with that. So when it comes to making these disclosures, ASIC has challenged a number of businesses on these because making no disclosures about risks and on strategies is also a problem. So just staying silent and not making disclosures is actually an issue. And a number of those organizations that ASIC has challenged recently were challenged on what I call green hushing, which is actually just being quiet about what's happening rather than actually making false statements. They just make no statements at all. And that's actually also something to really think about. Linking it to the ASX corporate governance principles, and also you'll find on the next slide, APRA, they're talking the same thing. TCFD is the base recommendations when it comes to climate-related risks, and also about how economic, social, and how economic, environment, and social sustainability risks impact that. All of the regulators in Australia are talking the same language. TCFD, disclosures on risks and opportunities that link to climate, and then also in some cases your social and government, which is your sort of base ESG. I think that's probably all I'm going to cover at this point, Aletta, and hand over to you if there's actually anything you want to say before we jump into the meats and the guts of the TCFD.
No, I think that's good. Thank you very much, Kevin. So we've been talking a lot about the TCFD recommendations, that it's a stepping stone for IFRS S2 and ultimately also S1. We've tried to explain why this is a potential risk area for businesses. If you do not consider, at least do a gap analysis, you'll be exposed. ASIC could ask questions. There's an expectation that organizations are thinking about climate risk. And a way to think about climate risk at the moment is through the lens of the TCFD recommendations. And going forward, it will be through IFRS S2. So what are these recommendations? Now, I've got a link to the publication. And some of the key features is it's adoptable by all organizations. The idea is to include this information and the TCFD recommendations in your annual report, your financial statements, in the OFR. There's a strong focus on risks and opportunities related to transitioning to a lower carbon economy. And in Australia, absolutely a focus on we have to move to a lower carbon economy, be net zero by 2050. And if you want to be net zero earlier, again, how do you plan to achieve it, etc. So there's a real focus on those risks and opportunities because there are risks as well as opportunities. To give you an idea, and these are extracts from the TCFD recommendations, when we look at the the risks, climate-related risks. Some people would think climate-related risk would only be floods and fires, bushfires. But if you look here, some of the climate-related risks could be technology risks, the substitution of existing products and services with lower emissions options, or the risk that we have unsuccessful investment in new technologies, or a risk could be the, the costs to transition to this lower emissions technology. Another climate-related risk could be related to the market. We can have changing customer behavior. We can have uncertainty in market signals. We can have increased cost of raw materials. So all of these are climate-related risks. So I just want to break the nexus that people just think it's flood and natural disasters. That would be climate risks. A big part of climate risk is what they categorize as transition risks. And that is transitioning from where we are today with high emissions to a future state where we've got net zero emissions. And how will that transition impact your business? Because a lot of organizations might argue we're not in a flood zone, and we're not in a bushfire region, and we don't have a lot of earthquakes. So we don't see the problem here. But if you start to think about these technology risks and the market risks, and even policy and legal risks, the potential exposure to litigation, etc., then it becomes more real. So please don't just think about floods and natural disasters. Please consider these other risks. I've got some more. There's also reputational risks. There could be shifts in customer preferences, and we're seeing that. We can see the risk that a certain sector might be stigmatized. So maybe you're in a sector that is not moving towards a low carbon emissions, and they're saying, we don't want to deal with that sector, and it will have an impact on your revenues. There could be increased stakeholder concern or negative shareholder feedback or negative stakeholder feedback. So, at AGMs this year, I think it will be very interesting to see the questions that will be asked of boards, of executives around climate change and what they've done or haven't done. I think the AGM season is going to be interesting, and it's around these increased stakeholder concern. And then also, obviously, physical risks. Now, I think the physical risks, I'm not going to explain because people get the physical risk. I'm asking you to look past these physical risks and also consider these transition risks. On the right-hand side, there's potential financial impact. So yes, there's risks, but also it has potential impacts on financial statements, if that's your main concern. Some other things would be around resource efficiency, maybe use more efficient modes of transport, the use of recycling, the move to more efficient buildings, reduced water usage and consumption. All of these could be risks. There could be energy source risks. How do we use new technologies? How do we participate potentially in a carbon market, etc.? So a lot of risks to think about. I think to get you thinking about the risks that we're talking about here, further than the basics, we could look at products and services. Maybe we should develop, or we are developing and expanding our low emissions goods and services. Maybe there's new products through R&D innovation. Maybe there's a shift in consumer preferences. If you look at your markets, there could be access issues to new markets. There could be the use of public sector incentives, etc. So a number of risks, and in this instance, opportunities that's available to your business. So you could use this as a bit of a checklist. Do these risks impact my business in any way? do these opportunities impact my business in any way? It's just getting you thinking about what climate risk and opportunities could be. In this diagram, they try and link all these transition risks that we've talked about and these physical risks, as well as these opportunities, and say all of these risks and opportunities and go through them and identify the ones that are relevant. How does it impact your strategy? How does it impact your risk management? And I think what's really important is when we look at climate change, to embed climate risks and climate opportunities in your strategy and your risk management is critical. It cannot be a separate thing. I had a wonderful conversation with one of our risk advisory partners where he's saying the worst possible thing is where you've got a risk register for all the other risks and a separate risk register for climate risks. I mean, how does that help anybody? It's to link the two and to embed it. And those strategic initiatives and risk management flow through to a financial impact in your income statement, your cash flow statement, your balance sheet. And that's where the linking comes between all of these risks and opportunities and what we've got in our financial statements. Now, earlier, Kevin talked about IFRS S1 and S2 are structured aligned with this. We look at governance, we look at strategy, we look at risk management, and then we get to those metrics and targets. It comes from the TCFD recommendations. So it's just at a governance level, how are we going to do it? Then how do we get it to strategy? How do we get it to risk management? And ultimately the metrics and the targets. There are a number of principles here for good disclosure. So it should be relevant information. It should be specific and complete. It should be clear. It should be balanced. No greenwashing. It should be consistent over time. It should be comparable with other entities within a sector or an industry, and that's what the regulators are actually using. The regulators will look at a sector and they would see that almost all entities have TCFD recommendations of a certain kind, and then there's a few outliers that either do the TCFD recommendations, but they miss the key risk that the competitors picked up, or they do nothing. And then they will ask, what's going on? How is this an issue for others in the sector and not an issue for you? So we want that comparable information. The disclosures has to be reliable, verifiable, objective, and it also should be provided on a timely basis. Now, this is a summary of the 4 pillars, and there's only 11 recommendations. So 2 governance recommendations, 11 around strategy, 3 around strategy, 3 around risk management, and 3 around metrics and target. So we're not talking about a huge set of literature here. We're talking 4 pillars, 11 recommendations. And if you can start with these, even if it's initially more at a higher level, and then break it down to further detail, that would really be amazing. The way it's structured is there are these recommendations at the top, there are recommended disclosures, and then there's guidance. There's guidance for all sectors, so all entities, but then there's also additional guidance for certain sectors. So if you look at the TCFD recommendations, you'll start with the dark blue, the recommended disclosures. You'll supplement it with the guidance for all sectors, and then you'll go and see if there's anything specific for your sector that you could pick up. And that's how you would tackle it. So what we've done, and we actually, or Kevin, I only approved this checklist this morning. Our clients and markets team have been working really hard. When I said to them, I need a checklist. I want to go to clients and say, here is a checklist to help you to do a gap analysis around these TCFD recommendations, a really quick and easy way to do this analysis. So after today's webinar, when you receive the PowerPoint slides and a thank you note, you'll also find attached to it a PDF, and it's a checklist. And I'll show you some extracts from the checklist, and we're trying to help you. So you can look at them one by one and see whether you've got it in place, so you can disclose it, or maybe that is something to put in place in the next year, etc. And what we've done to develop this checklist, we haven't just listed the 11 recommendations across the 4 pillars. We've actually also added the disclosures or the recommended disclosures that's applicable to all sectors. So it's kind of a one-stop shop around the recommendations and recommended disclosures for all sectors. Obviously, we haven't added additional disclosures for specific sectors because it then gets really complex and lengthy again. So this is what it looks like. And this is an extract around governance. You'll see on the right-hand side, there's an option to say, I've completed it. So if we look at the first recommended disclosure, describe the board's oversight of climate-related risks and opportunities, the guidance there would be, in describing that oversight, you should consider discussing the following, right? So the processes and the frequency by which the board and or board committees are informed about climate-related issues. So you could say that they are informed on a monthly basis, a quarterly basis, etc. Whether the board or the board committees consider these climate-related issues when reviewing and guiding strategy, major plans, etc., risk management policies, how the board monitors, oversees progress against goals and targets for addressing these issues. So in a way, this guidance is somewhat already drafting what your policy and your disclosure could look like. You just add in the specifics for your organization. So it happens every month. This is the committee looking for it. This is the committee who's reporting. This is how they're looking at it. And we've done this for each and every of the 11 recommendations. So the recommendation, the 11 is on the left. There's guidance, things to consider, and then you can tick whether you've completed. If you've already completed it, put it in your 30 June 2023 financial statements in the OFR. If you haven't completed it, put it on the to-do list for next year. And you can even use this to have a little bit of a compliance matrix in your OFR. And this is the status, and this is maybe when we plan to do it, if we haven't done it yet. So this is what the strategy would look like. So again, you can see we've tried to make it really relevant, and you can click which of the things you've already done. So that strategy goes over 2 pages, a lot of things to consider, a lot of opportunities, not saying you have to do everything. These are just the options that's available to you. I think this is handy. Then we look at risk management, again, a number of issues to consider. And finally, we look at metrics and target. And again, targets, and that goes over 2 pages. Sorry, I just want to go back to this one. You can see there under metrics and targets, the second one is to disclose scope 1 and scope 2. And then on the right-hand side, we said organizations should provide their scope 1 and scope 2 emissions independent of a materiality assessment. So that's interesting. Usually we tell our clients, you have to do a materiality assessment in order to identify whether your stakeholders or what your stakeholders are interested in. What they're saying here is, hang on, carbon and emissions reduction is such a generally accepted strategy priority for governments, for organizations, that it doesn't matter what your stakeholders say. It doesn't matter what the outcome of your materiality assessment is. You should measure and report at least scope 1 and scope 2, and over time scope 3. And that's an interesting one, a really interesting point to make. And then a little bit of additional information around metrics and targets. So again, these are some extracts. I think the publication is 10 or 11 pages. There's a bit of an introduction and a little bit of how can we help you at the end. But it's a very short checklist that hopefully you could use, and you'll find it useful and handy on this journey. Then the other thing to just flag here is the one that I've just read out around scope 1, scope 2, and if appropriate, scope 3 emissions. A lot of the work that Kevin and I and our broader team currently are doing is measuring scope 1 and scope 2. And then people will say, Aletta, once you've done with that, let's do scope 3. And once you're done with that, let's look at a decarbonization strategy. So it is a process over 2-3 years. Scope 1, scope 2, let's learn, let's map, let's understand. Then scope 3, then decarbonization. This is not something you do quickly. And you have to take a lot of people in the organization on a journey. So it's a lot of education. It's a lot of education of a lot of individuals across the business so they understand why we're looking for certain data and why we want them to capture additional data and how we need their input on how to do things better and how to decarbonize. So it's a big transformation journey across the business. So just a reminder, again, I've said earlier, we've got these webinars that we've released for the next 6 months around sustainability and about carbon footprint. It's very specific because we know at the moment the questions we are being asked are around measure our scope 1, scope 2, and scope 3 carbon footprint. So we want to do a series of webinars to start that education journey on what's required. And obviously, if you then need help, happy to assist with that as well. So a bit of an overview around these different scopes and how scope 1 is under your control. Scope 2 is indirect, but it's electricity, their own little place in the world. The rest of the indirect emissions are scope 3. Some are upstream, so it happens before they arrive at your gate. Some are downstream, so the emissions happen after you've sold the goods or provided the service. And this is just another way to reflect the different emissions. Scope 1 and 2, fairly simple to measure. It's a good place to start because it's not too overwhelming. Scope 3 gets nasty, 15 categories in scope 3. But I said to Kevin in our internal group yesterday, we've actually discussed the hardest part is actually the bit before scope 1. And that is determining what is the organizational boundary, which subsidiaries, joint ventures, associates, investment, who's in, right? And then when they're in, and we know which entities are within this boundary, what activities are scope 1 and what activities are scope 2 and which of these activities are scope 3? Because there's often an overlap or a tension between scope 1 and scope 3 or between scope 2 and scope 3. So for example, electricity, all your purchased electricity is scope 2. But if you pay an IT provider to host your data, and that data center uses electricity, that electricity usage by the data center, is that scope 2 or scope 3? All right, so it's scope 3, but there's an assessment that has to happen around that. All right, so it's just not simple. A whole new world. So we've got a publication to give you a bit of a flavor for it before the webinars. But please register for those webinars. It's fascinating stuff. I'm loving it because we're learning so much, and every time we work with new clients, we are challenged with new problems. Love solving problems. The other thing that we see within the TCFD recommendations is a need to do a scenario analysis. So this is forward-looking assessments of climate-related issues. And these forward-looking assessments of how climate-related issues could become a reality for a business is really important for our stakeholders. And they're incredibly interested not only in the physical risks, but how we're transitioning to lower carbon economies. They want to know what we think our vulnerabilities are and what we do to mitigate those vulnerabilities through our strategy, through risk management, etc. So scenario analysis is a very important tool for understanding strategic implications. For some businesses, scenario analysis is extremely complicated, and for others, it's easier to deal with. And I think the checklist we talked about earlier about all those potential risks could be very handy in this process. So it's all about a scenario analysis is just a process for identifying and assessing potential implications of all these things that could happen in future. So again, we can talk about that a bit, running out of time. So here is some additional information of what scenario analysis is and why it's a good thing. Happy to talk to you about that. Current use of TCFD recommendations, there's this report issued last year on which entities are actually using the TCFD recommendations and how it's been used across the world. And there's some key takeaways and findings, which I found really interesting. So you'll see here at the bottom, investors and others use disclosures in decision-making and pricing, right? So what we do here is of importance to those investors. And then we can see a little bit higher, a majority of asset managers and asset owners report to their clients and beneficiaries. There's some really interesting stats there to just have a look at on how widely used this is. And you can see Australia is not doing badly in its adoption of the TCFD recommendations at all. The TCFD recommendations have been around since 2017. So this was a review after 5 years. And I think Australia has done quite well, given that we haven't had a lot of support from government around climate change before at the end of 2022. So entities in Australia has done all of this voluntarily. It's not mandated yet. So just some stats. Some examples that I want to flag, and although we don't have a lot of time, you can look at these in your own time. If you look at the zero, and I've got links at the bottom of all the slides, the zero TCFD roadmap, you can see how they are not saying we've done everything. Some of it is completed, some of it is in progress, and we will continue with it in the next year. But it's a status update. It's a roadmap. Here are the recommendations. This is what we've done. This is what we're working on. This is when we expect to finish it. So that's a really good, simple way to deal with it. And I like the actual roadmap. This is the IAG net zero roadmap. Similar, here they look at their scope 1 to scope 3. And they say, scope 1 and 2, we've looked at direct operations. For scope 3, supply chain, we'll be doing an FY25 and beyond. A part of scope 3, there's commuting and business travel, the yellow, we'll do that in 24 and 25. So they've given you an idea how they're tackling measuring scope 1, 2, and 3 over time, which again, I think is a very cool way of doing it, making it very clear what you're doing. This is their climate-related disclosure. So they have on the left-hand side the TCFD pillars, the actual requirement, and then on the right-hand side, the high-level achievements in FY22. So they're not saying we've achieved everything. They haven't listed all 11 recommendations. They've just put together the 4 pillars, and against each pillar, this is what we've achieved. And then we'll endeavour to do the rest going forward. So this is the findings from a gap analysis in a way. So you can see there's not many people that have this perfect at the moment. It's a journey, and it's to disclose your journey. So the NAB climate risk assessment is fairly impressive. So they've got transition risk, physical risk, they've got all those risk drivers that I've showed you earlier. They explain the impact. They also have a column for the impact time horizon. Will this be an issue for NAB over the short term, medium term, long term? And then they also talk about the impact to other group material risk categories. So this is the linkage between climate risk and other risk within their business. So they've integrated climate risk with other risks. This is the Woolworths climate risk. Again, they said climate, the strategy and risk management, they've got all the aspects. I've just taken a screen grab of strategy and risk. They say our climate change strategy has been endorsed by the group and covers the following 5 pillars. So this is quite a lot of detail around climate risk strategy. They also have detail about metrics and targets and governance. But you can see, again, they're quite advanced and they give the details. So just in the nick of time, a focus for 30 June 2023 reporting, there's two things. TCFD recommendations, conducting that gap analysis, use our checklist for a gap analysis, report the findings. It could be this is what we've done, this is missing, or this is what we've done, we're working on the rest. It could be this is what we've done, this is when we'll achieve the rest. Various alternatives, but don't neglect TCFD recommendations. And then measuring your carbon footprint. It could be we're starting to measure it. It could be reporting scope 1 or reporting scope 2 or whichever way. But both of these aspects will help you to whatever Treasury announces in July and August, will help you to meet mandatory requirements. And I just want to make a real final comment, and I should have said this a long time ago, actually. What I'm hearing from clients in the UK, but also clients in Australia, those listed entities that will be caught by mandatory reporting first, so mandatory reporting of their carbon footprint, scope 1, scope 2, and scope 3, they are in the process of reaching out to their suppliers and saying, you are part of my supply chain, you are part of my scope 3 emissions. Are you measuring your carbon footprint? What is your carbon footprint? What are your targets? Right? Because remember, you are part of my supply chain. And scope 3 is usually 80% to 90% of the total emissions of an entity. So the pressure will be coming down the supply chain for a lot of entities before it's coming through mandatory reporting. There's free TCFD training if you want to know more. There's the 6 webinars around carbon footprint. So we're dealing with both aspects. And obviously, if you need assistance, we've got a number of core services around measuring your carbon footprint, reporting your carbon footprint, TCFD recommendations, IFRS S2, and also assurance over those. So can we help with that measurement of your carbon footprint? Please reach out to Kevin and I. Can we help with the preparation of your TCFD disclosures or your gap analysis? Reach out. These are our key contacts around sustainability. You can see Kevin and I are there across Sydney and Melbourne. And then also the IFRS team are also looking at both of these aspects. So as always, you can contact these friendly people and our broader team as well. I want to say, Kevin, thank you for joining today. This was fun. And good luck for everybody to get their 30 June reporting done at a high quality, keep the auditors happy, and speak soon.
Goodbye.
Oh, I've got a blue screen here, Kevin. I don't know where it's coming from. What's happened? Okay, bye-bye, Kevin. Thank you.